Good evening, everyone, and a very warm welcome to today's webinar on navigating the dichotomies in MSME investing, challenges and opportunities. I am Arvind Ravindran from PMS Bazaar. MSMEs are the backbone of India's economy, contributing significantly to growth, employment, and innovation. Yet, when it comes to investing in this space, the journey is far from straightforward. Unlike mainstream markets, MSME investing comes with its own set of unique dynamics where traditional rules don't always apply. Through this session, we aim to peel back the layers of MSME investing and help you see it through the eyes of a seasoned fund manager. Together, we will understand how MSME fund managers think and make decisions, explore why India's MSME capital market is closer to private equity than public markets, learn which conventional rules simply don't apply here, bust some common myths about microcap investing, and finally uncover the real challenges as the hidden opportunities that lie within this exciting but often misunderstood segment. Today, we are delighted to have an insightful speaker with us, Mr. Rishi Agarwal, co-founder and fund manager at Aarth AAF, who will guide us through these nuances and share perspectives shaped by their on-ground investing experience. Mr. Rishi Agarwal is a CFA Charter holder, chartered accountant, and certified AF manager with over a decade of global experience in finance, assurance, and investments. He previously worked with PricewaterhouseCoopers, advising multinational clients on specialized audit, controls, and risk framework. His expertise spans investment strategy, risk management, and portfolio construction for family offices, corporate treasuries, and institutional investors. At Aarth Growth Fund, Mr. Rishi leads the investment strategy and risk management, filtering a vast universe of companies to identify scalable MSMEs and growth stage businesses. His research-driven approach and disciplined capital allocation aim to deliver sustainable alpha and long-term value creation for investors. Welcome, sir. And I would like to hand over the session to you for your presentation, sir.
Namaste, everybody. Thank you, Arvind, for that small introduction about me. This evening, and it's a Friday evening, so I will not make it a boring session. Having said that, good evening, everybody. I'm Rishi Agarwal, fund manager at Aarth Growth Fund. Today evening is not about stock tips in MSMEs or a brochure about our fund performance in last 9 months. It's about discussing, contemplating on the decision-making framework which we have envisaged, we have experienced in our experience. Today, I'll make 3 promises to you. We'll define where alpha comes from in MSMEs, how we capture it, and just like all fund managers who are very afraid of burning capital, what guardrails we put to protect capital. This slide captures the scale of MSMEs in India. We would have heard a lot of conversations on CNBC, on Instagram, and even on Twitter that we have about 3.7 crores MSME registered in India, 26 crores formal jobs, 30% of our GDP is from this sector, and almost half of the exports and manufacturing comes from there. Now, these numbers are huge, voluminous, and useful, but this doesn't help us in defining how to start investing in them. Where does the edge come from? The edge actually comes from the translation of the initiatives taken by the government, taken by the MNCs, and taken by scenarios created globally and locally. Make in India, 1/4 of all government spending has to happen from the MSME sector. The government has understood that the only way to create sustainable jobs, diversified jobs across tier 1, 2, 3, 4, and even 5 will depend on credit given to these MSMEs. And these MSMEs don't have a large capital base, don't have a large asset base. So they need to be guaranteed by the government. They've also been offering interest relief on a lot of capital exposure where you set up small projects up to 50 crores or 100 crores. In fact, this budget, we have also seen the government capitalizing and re-rating the MSME definition to 500 crore revenue. Now, that's a big revenue and to be called into MSME, right? All these factors define the tailwinds, and these tailwinds become cash, and these cash surplus with the MSMEs, then allow them for growth capital. And then that's when you will see re-rating happens. You would have heard about a year ago that almost everybody called India a very expensive economy. And rightly so, because we were trading at a high PE multiple. Now, PE multiple, you all know, is of earnings. And if earnings growth comes down, your valuation becomes expensive. So as I was coming down, this cash which will derive from these initiatives will help in propelling the earnings. And we as a fund, our job is to identify gaps in the reality, in the media coverage, and the macro headlines. So a few examples of how we identify them is we identify sub niches. So every sector has subsector, every subsector has some regional nuances. Let's take it mining or even transport. So we look for local duopolies or oligopolies. That there are 5-6 players who sort of define the power because pricing power because they have the capacity installed. They have a decent management. They're innovating enough. They're looking at export alternatives. The TAM is small, and when I say TAM is small, it's about 3,000, 4,000 crores. But because a few players are looking at it and the TAM is growing at a 5% plus pace, it is fairly normal for the industry to go at 20% plus because you're also looking at global exposure. Second, formalization arbitrage. A lot of protection has been given in terms of GST, Udyam working capital, tax normalization, interest-free loans, which gives an arbitrage or an advantage to the MSMEs. And thirdly, which we are seeing on a daily basis, is supply chain disruption. The entire concept of outsourcing the entire manufacturing of a country to another country has completely gone off. Everyone's looking to diversify their supply chain on components, on sales, on services, so that no shocks arise, because every company is accountable to its board and the board is accountable to its investors, and nobody likes shocks in system. Now this slide is primarily interesting and it has a lot of numbers, so I'll take it slow. On the top left, you will see the total market cap of the MSME sector. Now let me define why this slide is important, because we have two exchanges in India, NSE and BSE. Both of them have a separate platform for MSME. One is NSG Emerge and second is BSE SME. In 10 years, since 2012 plus, about 10-12 years, about 1,200 companies have been listed. And these companies have raised 30,000 crores. Now, mind you, if you see that bottom left of the slide, within the last 3 years, 2.5, 3 years, 20,000 crores, that's 60% of the money has been raised in the last 3 years. Why? Because the entire framework has now become mature enough for this growth to propel. And you would have seen all the multi-baggers in the last 4 years. Now, this is the reason for it, right? Many of these small companies, in fact, to be precise, 350 oddish, have moved to main board. Now, these main board companies are then looked up by mutual funds because they have higher liquidity, they have higher market cap, a decent base on PAT and EBITDA. To give you a sense of wealth creation in MSME, 20,000 crore raised or 30,000 crore raised overall in last 10 years. And every company dilutes 1/4 of the equity, which is compensated by the exchange. So 20,000 crores into 4 is 80,000 crores. Let's take it 90,000, 1 lakh crores. So 1 lakh crore of market cap at the time of investment has become 3.5 lakh crores. That's 3.5x of wealth created at entire base level. So it is not I'm taking the top tier, bottom tier, I'm taking the entire base, an entire universe. So that's the universe we function in. For us, MSMEs don't only mean MSME SME platforms, it also means mainboard. So as I was saying, that the investor lens on these MSMEs are primarily on account of these are family run businesses. They are very cost sensitive. They cannot compete on brand like the others, likes of L&Ts and so on. They have fragile balance sheet because one, they are usually concentrated on couple of customers, couple of suppliers. Now, this used to be the case. As these companies are growing, they have realized over time that these are the areas which they need to invest on, either on the governance management or on diversification of their portfolio in terms of sale and marketing. And for this, they are raising capital. A lot of them are also raising private capital, which you also hear as pre-IPOs. So this is fairly a landscape of the capital markets and MSMEs. Before we begin to hear from me, what is my thought of the structure, how we invest, these are the five main dichotomies or dilemmas I face as a fund manager investing in MSMEs on daily basis. Me and my fund manager on daily basis discuss one of these five ideas on every company which is about to get listed, on every pre-IPO we're evaluating. And before we go on the poll, I will quickly leave with you with what these each of them mean so that you can make an informed choice. Risk versus return, typically very well known in the industry of investments, that what risk are we taking for the expected return? Because we are managing a portfolio, we have to look at the overall portfolio risk along with the script level risk. Second, either we should be a passive investor or an active one. A lot of our peers are passive investors, meaning that they buy an idea, they sit on it, and they only sell at a point in time or a valuation at which they want to exit at. Whereas active investors are trying to also capture a few momentum here and there, news events, or even triggers like M&As or right issues. Third, conformity and contrarianism. Conformity and contrarianism is fairly important because you have a lot of thematic funds who are investing into a particular theme because that's the theme of investments. So let's say you had solar, you had electrification, you have IT, AI, and contrarianism would believe that why not steel? Why not copper? Right? Known versus unknown, this is fairly important for all institutions because whenever they're going for evaluation of an institution or company, they have to look at the industry, the sector, the promoter, the region they are in, the pros and cons of each of these aspects, the TAM, the growth in the TAM, the possible risks they might face. But trust me, not most of the time we have more unknowns than knowns. And it's about building conviction on knowns and looking at what downside can the unknowns give you. And that is how you're able to define risk or even estimate unknown risk. And lastly, diversification concentration, fairly nuanced. A lot of PMSs, AIFs, mutual funds, great fund managers have prominently said that we make concentrated bets. We take 20 bets, 25 bets, and nothing more than that. We see mutual funds. If you open any mutual funds, I'm also SIP investor, having over 80 scripts. And that's a call one needs to take because eventually we all looking for risk adjusted returns. We have to underwrite both the coverage and liquidity. And that is important in defining this factor. So now I'll leave it to the audience to give me a poll on which we can further discuss and present what are the nuances we look at in this aspect. And we'll only cover one of them, whatever gets the highest votes. Okay, this is very, very, very interesting. So the top two are risk return, which is what I had expected because that's the first one I had kept. But the second one is unknown versus known. And I would have thought it would be the last one to have a significant concentration because most of the conversations I've had with my peers, with my mentors, and I've seen really startling examples. I know a few ultra HNIs or fund managers who have only taken 18 bets in their lives and they've done wonderful. And people who have run their bank account or demat account like multiple mutual funds, and they've also done fairly well. So if you look at this slide, I've divided the entire structure into three segments. Top left is pre-mortem. Pre-mortem is what is known to us, told to us by the promoter, what we have modeled in a financial model to see, okay, this is the expected PAT we see. So this example of a company, I'm not naming any company here, this simple example. This is a company which has done 100 crore of sales, 25 crores of PAT, a good healthy PAT margin. And we see a good 60% growth, 25% growth year on year. And this is normalized after 1.5 years because usually when people take money, they have an exponential growth if it is a working capital led or if it is marketing led. And if it's capex led, it fairly comes in 1.5 years from there. This is a story of, let's say, marketing or working capital led, right? So someone has taken money, they've given 4x of tenders with that. When we invested or when we are all investing, we are at a 14x multiple of 25 numbers, a market cap of 350 crore company, right? So this is what we know. Now there are a lot of unknowns to it because we have to factor in what kind of EPC contract they are in, whether the margins are going to squeeze. They might get stuck up in cash flow, so they might have to take debt. The few contracts might roll over, a few contracts might get cancelled. So we have to put a scenario, and I've given a very simple method on the right side, and the right side sort of explains you how we budget the risk. So top one is 27 FY. So if on FY 27 the PAT at 100% at a 6.79 P of exit multiple, I will be able to break even, right? So if the market downgrades the stock, and any EPC company you see will not trade less than 7 multiple, because it's fairly reasonable to expect a company to be in life for next 7 years in India. We are not in Germany or in Europe where you're 85-year-old promoter who wants to sell and has a very small TAM. So we fairly see, okay, capital is protected because we'll get an exit even if 1 year down the line, no needle moves and the company does same PAT. What if the company does lower PAT, which is 75% of what we're expecting? At 12p, we have made some money. At 14p, a lot more than that, and same was the case. In 28, similar expectation on scenario and exit P. While building this model, we also go into building the price. We also go into building the expected EBITDA and cash flow. And we do this for all things: PAT, cash flow, EBITDA. And we sort of define the price range at which, and every quarter or 6 months, we look at it. So companies who are below 200 crore market cap, we look 6 months. Above 1,000 crore market cap, we look at quarterly. And we don't do above that, but if we ever do above that, we'll try to look at them monthly, because there are a lot of moving factors and there are a lot of subsidies which come into picture. And the idea is just to build more conviction if there is more information, right? And we have to be very, very careful with our biases, which is why we try and put some number to it, because over time, numbers will not lie. My biases might. And this is how the entire team at Aarth is trained. We have about 12 analysts, and each one of them rely on numbers. We sort of read the numbers. Again, this is not an example of how we should do investing, but this is just the way how we sort of mitigate our risk or underwrite our risk. Eventually, it's all about engineering and reducing risk for us. I'll likely jump to the slide which talks about challenges and misinterpretation in MSMEs. And this is very, very important. The other day, in fact, yesterday, I was speaking to an extremely informed investor, and he told me, Rishi, many people have told me I should not invest in MSME anymore. It is fairly, I think the time is gone for MSMEs. We made all the returns in last 3 years, and I've stopped investing. I've taken everything out and I've put money in small cap and mid caps, right? This was back in January when we saw a big 30-40% correction there. And I told him, since January, sir, we have made 40% XIRR. Since January. We also had a big drawdown, but all the investments made in that time have given a wonderful return, because it's pure play of what risk you are trying to underwrite, what expectations you have on the earnings and PAT. And it's fairly easy from all the promoter calls you've had, all the pitch decks you have seen, all the financial models you had. And yes, even we go out of 100 bets, we have taken 12 might have gone wrong. But the balance, they give you a wonderful return. So let's talk about challenges. One big challenge is liquidity constraint. And it is a challenge, there is no doubt about it, which is why you have lot size concept in MSMEs and SME counters. In fact, very companies who are up to 500 crore market cap, I have seen 30-40 lakh of daily turnover, which is not very healthy. Because if, as a fund, I'm holding a 3 crore position, which is likely to become, let's say, 6 crores in 3 years. How will I sell it? And I'll take what 8 months to sell it, right? Which is why we do not size positions in a day. As a fund, we are fairly diversified because we might expect the script or the idea to be strategic idea. But if we are not able to find depth on it, which is not a product of the company, the promoter, or the merchant banker, it's a product of the market, the investors. If we are not ready to trade and invest on the idea or price it very frequently, as a fellow investor or a fund manager, I can't do it no matter how great the company is, because I'm not a PE fund. I'm a CAT 3 closed end fund, but I have also some restrictions and some rules. Coming on to governance concerns, extremely important. They're very, very good businesses we have left because of governance. RTP, related party transaction is a place which is must to be noted by everybody. In last 6 months, we have seen two cases where the SEBI had to intervene, stop the IPO only because of this aspect. Auditor notes, very, very important. We must look at the auditor because we are a fund. We have access to the CA community being a chartered accountant. It doesn't take me much time to pick up a phone, call my fellow members, ask them about the company, ask them about the auditor who's on the file. And if I find it to be a red tapeism or sort of just for the sake of being an auditor, we fairly do our own due diligence. Many a times we have lost on deals because we took time to do diligence, but we don't invest. It's okay if we miss on 10 great ideas because we have 20 more coming pipeline. Again, it's a volume game. MSME is a volume game. I don't need to be afraid of if I miss Adani bus or not. Thirdly, operational fragility. Very important because key man risk, one plant risk, two, three client risk, region play. These are all nuances which we have to factor in. And these challenges are real. There's nothing we can do about it. Having said that, we have to realize one thing, that if one person is doing one thing wonderfully, doesn't mean that it's a risk. It is also a moat. And that moat sort of gives you an expectation of for a couple of years what you can expect from the business. Because many a times when even startups you see, because we read so much about it on Mint or news channels, the lift causes sudden downturn. And we have seen wonderful startups burning money the moment they raise funds. That can't happen in public markets because the valuations will go down south if you burn money. So here people are really informed, they tread slow and they tread to build wealth and not destruct wealth. And lastly, volatility, very important. Personally, I've had scenarios where I used to question, and I have questioned my instinct, my conviction on many companies because 30-40% of market cap or the portfolio or portfolio level, I've not been so down, but on a script level, 30%, 40% is fairly normal. Just the other day, a big mainboard company, 20% wiped off in a month, right? And we had to build conviction again. So we looked at our notes, we spoke to the promoter, we went to the factory visit, we looked at financial model, looked at the order book, spoke to a few peers and find out nothing to worry. The correction is there. It is because someone is not able to price that horizon. We have it, and we went on adding position. So once you add a position, we're supposed to be able to price it even better. So our downside is risk. Many scenarios where it's 40% corrected, we just simply hold on, wait for the news of a turnaround to happen. Because if we are selling at the dark periods, we will simply destroy wealth. Because if you are selling at dark periods, you'll not be able to exit. Misrepresentation or misinterpretation of MSMEs, huge. I don't know why people call it penny stocks. The other day I was on in shorts, and most of the channels are saying penny stock got 5%, got a 10 crore order, moved 5%, and they'll name some HNI or ultra HNIs invested in it. Right? It is not about penny stocks. You have to identify the many leaders who are doing 400 crore, 500 crore, 300 crore revenue in a sector which is dominated by them. I know a company in Orissa. They are at a Paradeep port. 60% of all loading is done by that company. How can you say it is penny stock? Yes, what can be said is, oh Rishi, they only do in one location. They cannot grow pan India. Doesn't matter. Paradeep port is going 12% per annum. Works for me if he is able to get the market share and capture more and get more value add services. No liquidity or all reality. There's no two ways about it. But liquidity is dependent on the stage at what you're entering at. If your entry price and your valuation is correct, liquidity is not a concern for you. Why? Because your time horizon is what is important. I am not a liquid fund or a liquid mutual fund which will sell in 3 months, 6 months. So I might have to sell the entire portfolio at discount. I'm a 5-year closed end fund. And most investors need to think either you're investing for 3 years or 5 years. If you can invest into HDFC for 3 years, you very well need to invest for 3 years plus in MSMEs because you are giving primary capital for growth. MSMEs can't scale. 300 plus companies went to mainboard. Very big example. I can give you numerous examples on my website. You have some anchors we have done Forex in terms of everything, revenue, bottom line, market cap. So not a question in hand. Failure rates are too high. Yes, failure rates are very high. I see 60% of the companies will fail. Balance 20% of the companies will not find new buyers. right? And that's a reality. Why? Because many of the ideas take over 3 years to mature. They're capex ideas, they might have to pivot their business again. So, yes, your failure rates are high, which is why we call ourselves a more deductive fund than a productive fund, because we sort of reject 6 on 10 companies which come to our desk every day, 60% rejection rate. And even then, we have 72% success rate. So it's very voluminous that way. Rules that don't apply to MSMEs, and I'll make this quick because I think we're going to be some time. So liquidity comes first. This is the rule of investing, that we must invest in liquid stocks because we might have to exit. Again, I'm saying for a open end mutual fund, for an investor who's put in only 6 months of their capital or has a horizon of it being a 1 year, at max 1 year goal setting, it is important. But in MSMEs, liquidity follows. Valuation discipline comes first. And even for the large mutual funds, I remember speaking to Parag Parekh, fund manager at one of the CFA conferences. He's at a 1 lakh crore AUM and he still preaches that valuation discipline comes first, Rishi. Promoter holding, very, very important, right? I've joined promoter holding first. I should take the institutional holding first. So I'll take institutional holding, promoter holding goes hand in hand. When I was studying for CFA and consulting family offices and sovereign wealth funds, one of the criteria we had was 25% plus holding should be by an institution. Why? Because when an institution has a seat in the board, they sort of ensure governance, fraud risk is protected, so on and so forth. MSME is exactly opposite. We look at anything 70%, 40% below promoter holding is a risk for us. Why? Because we don't know who is governing, who is calling the shots. In fact, we promote. There are many a time the promoters holding is by the mother or by the daughter or by the daughter-in-law, and we actually appreciate it more, even they don't play an active role on the board, is because any promoter or any individual will think 10 times before doing any funny thing in the company when their director and the largest promoter is a female of the household. You would never do any fraud. And that same aspect and principle has been followed by Ikigai as well. So even the small cap people are recognizing this as a triggering point. Stock price is equal to business health. If you remember Amazon's uh, founder Jeff Bezos, he was saying that my stock price was going down, 40% down, and all my business KPIs were going up. And this is fairly common in MSMEs. We see it every day. Today we spoke to promoter, 30% of his entire stock is gone down. He's trading at 9.6 P, and he's fairly renowned in the space of uh, infrastructure. And he said, Mira, why is my stock 30% down, Rishi? And I told him it's not your fault. It is not your doing. It is about how you're being perceived as value. And it will take time because you're not going at 2x every year. So if you go 2x, people will jump on you like a bandwagon, which is buy at any price. But that's not the case for you. So you will take time. You have to be patient on that. And he asked me, can I buy my own stocks? And I said, yes, you're 70% holding. You can buy 5% more. And he's happy to buy it. And this is not an OFS. So that shows conviction on our own company, right? Second, lastly, market always prices in growth. Not true, because in MSME, you will not see a single coverage report. You will not see anyone selling it. In fact, most MSME companies don't even have an investor relation. And that's anyone who's looking for financial services. IR is the single biggest services you can invest into. If you're good at communication, your finance is great, you like to understand companies, please become an IR. I can give you 100 companies who you should work with. EY has entered into IR of MSMEs. 17 companies I have recommended them. So it is really important because narrative is really important for investors to perceive within an hour or so. You can't expect every investor to come to your factory, spend 2 days with you. Impossible, right? Many of the investors are not staying in India, in fact. So you have to have that coverage, and that coverage is really not priced in MSMEs. And lastly, institutional coverage ensures quality. Not true. We have seen many examples where your broker reports and analyst reports have been for companies, and you've seen exact opposite happening. So please take every information with a pinch of salt. Do your own little bit of due diligence before you invest. don't transplant large cap rules. It doesn't apply to MSMEs always. If I had more time, I would have told you what's our framework, what's our methodology. But on our website, there is a link to our investment opportunity. We have broken up in 3 steps. What is our philosophy? What is our framework? And we have given 5 examples of no go or not to do things. And you can have a look at it. Investing into AIFs, and let's say my AIF, gives 3 advantages. One, what we are not able to recognize is we are going through a transformation. And this transformation wave is not only for us. It has played for United States in mid 60s. It has played for South Korea. It has played for China, even for Japan. And why am I saying this? As a demographic dividend, we are 35 to 40 year age group will come to light. Most of us will require institutions. And institutions are not built by individuals, it will be built by people who are smart, driven, are ready to create value. That is what we are going through. We'll see a lot of companies acquiring. We have seen a lot of companies and given capital to acquire companies in Germany, in US, in Texas. We have put a pharma plant. And in Germany, we have taken 2 companies at 5x of EBITDA. And they were making into large steel tankers for gas because LNG and CNG require some transportation in that space. So core engineering is really moving up. I think now is the time for Indian engineers to really go down on the garage, create something, ideate the product, and go to the market. And exhibitions are a wonderful platform. I myself aspire to go to every exhibition possible. But what we have internally figured out is there were 12 exhibitions in the world for each sector and each segment, and you all should visit that. All ultra HNIs who are looking to price the discovery premium, you have to access these companies. You can access them at PE stage if you are really a risk taker where 1 on 10 ideas will succeed. You can access them in pre-IPO stage where 3 on 10 ideas will succeed. You can access them at listing stage, 6 on 10 will succeed. Obviously, all of them require a lot of effort. And which is why a lot of my peers will grow in the industry. I'm seeing since our fund has opened, about 20 odd funds have opened, 1/5 of our scale. We are top 3 in India at what we do. But this is happening, and that really helps us build conviction because all these are peers, the market is huge. And we talk about the companies, many funds are based out of Calcutta, one is out of Raipur, now they're out of Indore, we are out of Jaipur, right? So we are also regionally dissipated, and we are not competing because we're not out of Bombay. At every second shop is an AIF, let's say. So it works for us, and we are a focused fund. Our style is completely PE style, but we want some liquidity. Which is why we are 80% plus in listed space, and we aspire to be in high growth companies, decent quality, because you not get best quality at high growth. Trust me, not because it will be already priced. So that's about the thesis about the growth engine and how you can participate into the story. Some of you might have seen our website, might have Googled us. So just to give you a glimpse of it, we are a Cat 3 closed-end fund. Why we are a Cat 3 closed-end fund is because it gives us a liquidity edge. As I mentioned earlier, we have the entire breadth on the universe, pre-IPO, anchor, secondary market. Because we are a fund, we have certain risk filters in terms of governance, forensic accounting, inversion theory, what can go wrong. Let's strike that out. And institutional discipline. Many a times I am able to build conviction without numbers, without a logic. And my analyst simply says, sir, please tell me one reason. You have to give me 5 reasons, not one, that why you have this conviction. And that really questions us when you go and buy and sell. And because of the entire process which we discussed, the entire design framework which we have, on the right side, you'll see we are the only fund in India which has been ranked by PMS Bazaar in top 3 in last 6 months. And our ranking in April was number 2. Our AUM was half of what it is today. Now we are 2x the AUM, and in July we are again number 2 ranking. And this is pan India in all Cat 3 closed end. I think, in fact, even open end is there. So all Cat 3 AIFs is covered here. So that's a great validation from them. It helps us benchmark ourselves. I wanted to cover, where citations are. We have taken this data from public information, most of it. And this is our phone number. You want to WhatsApp us, our email ID, and our website. Thank
Thank
you,
you,
Arvind.
Rishi sir. In fact, we are fascinated by that XARR which the fund has delivered, sir. And it's not even a year since the launch. Participants can now post their questions in the Q&A box. So before moving on to the audience question, I will ask you a few questions, sir. So generally, how do you see this dichotomy between India's formal and informal economy playing out for the MSME investors, especially as more businesses shift towards formalization?
It's a really good question, Arvind. And because I used to speak to myself when I was at PricewaterhouseCoopers, we were doing a lot of M&As there. And one of the companies I worked with had acquired 170 companies in automotive in US. The fund is Apollo. They put about, I think, about $20 billion or something. And I was just surprised that why did they even do that, right? And it was very simple. They acquired all those 120 companies. They found out that 10% of the entire expense is fat. So when I go to the gym, I see what is the fat percentage? It's all inefficiencies. They spent 3 years in cutting down all the inefficiencies. 120, they reduced 30 companies, all structures went out. About, I think, 4,000 bank accounts, 200 bank accounts. So all the float went out. They put in house banking. And by that itself, the entire money they had paid for was free in 3 years. So what I'm trying to say is that formalization has the power to compound, to to reduce inefficiencies. And with this MSME platform and people getting listed, the mindset of promoter is now that I want to create wealth for the nation, for the investors, and thereby for myself. Because you sitting on a 10 crore profit will give you 10 crore in hand, out of which you will reinvest half in business and 5 crore you might take home. But the 10 crore profit translates to roughly about 50 crores of market cap, right? And you don't need all that money in one go. So you should ideally reinvest, allow a formal structure to be in play if you have more cash and if you're able to integrate smaller companies, acquire them because many companies don't have a next legacy. So we will see, I possibly see approximately 20% of all MSMEs getting acquired in next 5 years. Recently, we have seen Adani buying 1,000 crore companies over 3 years and many companies, about 150 odd companies he's targeted. So it's happening, it's a reality.
That's a sharp way to put it, sir. Appreciate that. So GST 2.0 reforms promises smoother input tax credit, faster refunds, and simpler slab structure. For MSMEs which face liquidity pressure from delayed receivables and dependence on bank guarantee, how much relief can these reforms really provide them, sir?
So the government doesn't think for people. At least this government is not a vote bank government. And the reason why we are seeing all these reforms is because, as I mentioned, 10 crore worth of loan can be taken from a bank where the government is the guarantor. So if I default, the government has to pay the bank. Eventually, the government is also underwriting a huge capital, right? And they will have to allow money not getting stuck with the MNCs. So now, up until now, you would have seen that 45-day benchmark. If they don't pay money in MSMEs, they can't claim in tax and they have certain disclosures. That has allowed the cash flow to punch in. They've allowed this entire credit to come out. So when the large cap companies get more earnings, they'll be able to allow earnings to smaller companies. Entire Mahindra story. Every time there's a car out, I know 5 companies where I have put money who's supplying a fuel tank, who's supplying some of the other component to them. So it is a story which is trickling down. It has to happen, and the government will support it because that's the only way to propel and protect wealth.
Good point, sir. Let me push this conversation further by diving into your product. Your fund has delivered an exceptional 60% XIRR since inception, sir, with only 80% of the capital being deployed, suggesting some upside still remains. Could you share some of the emerging themes or investment opportunities you are currently exploring that you believe could outperform even the current portfolio holdings?
Right. So just to give you a few information which are not in the pitch level website, we are a fairly active fund. And by finally giving you a number, because I believe every statement has to be backed by number, we have made approximately 80-90 crores of profits, PNL, of which half of it is realized gain. So I have already clocked in half of my gain and sold Because as I said, as a fund manager, I have to think, where am I placing the bets and how large can I place the bets? If I can't go bigger, I exit. Unfortunately, I have to as a portfolio management. So we are a fairly active fund. Therefore, all the XRR you see, half of it is already priced, meaning exited. So I'll enter new ideas because I have cash in hand and I have more cash to come. So the potential is still there. In fact, when my NAV had gone up to 150, 140 oddish in January, and people who had come in January as new investors, they didn't make money for 4 months. So up until June, my NAV didn't go to 145. And many of them, also my friends and family, were saying galat time dal diya paisa. And they have made most money now because the next drawdown came in and they had put in at a lower NAV. And now the NAV is north of 160. So everyone's made money. The worst entry of investor level 2 has made 45% XIRR. The first investor made 60% XIRR. Everyone made money because the fund is structured that way. We are not a bullet fund where you put in 2 crores on day one and then after 6 months you get 20% return and you exit. Because if you do that, even the fund has its own restrictions. They have to maintain, keep that cash in a large cap company or in GSEC bonds or in gold or in cash. Now, that money is just sitting idle. It is not invested into growth ideas. So, because we're a closed-end fund, we'll be able to create 60% is definitely a phenomenal returns. I don't claim that we'll do the same for next 3 years, 5 years. But on a 5 year period, if you're able to 35%, 40% XIRR, that's huge. We have 4 times the money, right? And that's big. So there is a lot of opportunities left. New companies will come at a cheaper valuation probably, or they will come in themes where tailwinds are about to kick in. So we are a fairly active fund. We'll churn very fast, which we are churning. At least half the fund we churn every 6 months, and that will make us outperform everyone else.
That's a very impressive track record, sir. Just to extend that thought, I think you are nearing the close of your fundraising. So, can you tell us how the drawdown schedule would typically work for an ideal investor looking to invest in this fund today?
So, sitting today, we are almost 85% committed. So, of 500 crore capital, I think 480 crores is already committed, and people have given 80% money. Anyone who comes in now will give 80% money so that they're equalized to the previous investor, and 20% will come in December first week. In fact, when we made the fund, which is last year December, we had consciously decided that we'll communicate to the investors, we will take money every quarter. Cut to March when the markets were very, very down. In fact, Feb end, most of them said, Ki, yaar, why are you taking money in? And everyone expected the market to go down further, right? But we have 220 plus investors. You can't have 10 people's feedback change the entire framework of the method. And we realized today we are a closed end fund. What if we were open end fund? Would we have an option to avoid capital? No. And let's reiterate. That's when we decided let's be active. Let's have half the portfolio being active. So 80% now, 20% in December first week, and then your money will come back to you in 3.5 years when we start distributing money, and we'll distribute in tranches. So that let's say suddenly you don't get 5 crore rupees and you know what to do. So if you put in 1 CR, it becomes 4 CR. God's grace, it does. Then we'll start giving you in 50 lakh every quarter or a crore every quarter.
Thanks for clarifying, sir. Now I have a special one. Can you share more about the origins and structure of your Aarth framework? What inspired its development? How was it constructed? And in what ways has it provided an edge in your investment process over time?
Ah, so we have exactly rewinded 1 year ago. 1 year ago, in August, September is when we were deciding what will be our framework of investment. And all of us are obsessed with our name. So even we wanted to tie it back to our framework. It's there on our website. The origin stems from the fairly three-pillar idea, which is governance, management, and business. We have trickled it down to two more thoughts. The T is for time and horizon. Timing and horizon very important for us because as a closed-end fund, we have the option of buying when everyone's selling. And because we are a closed-end fund, we have to exit within 5 year horizon. So if I was an open-end fund, I would have been under a pressure of timing because you never know when the market will go south and we have to redeem. But I will still have the option to invest into 7 year frame ideas. Today, I can't do that. So last two are primarily to factor in our constraints. And this was inspired through all the studies we did in CFA, spoke to the family offices, worked with the seven sovereign wealth funds, and that's how we structured it. So we are using same principles, but looking at our framework, our nuances of the fund and the universe of MSMEs, we've nuanced it.
That's fascinating, sir. I think in interest of time, we can move to audience questions, sir.
Please.
If you are okay.
Yes.
So Rajarajan is asking for accredited investor, what is the minimum investment?
As I told you, we have only 20 crores left. So for
Okay.
everyone, the rule is 1 crore investment, which is by the SEBI rule. And because it was a first fund, and my co-fund manager and our sponsors, our friends and family, money is invested primarily, and a few word of mouth. We don't have any sort of different segments of class A, class B, C, C1, C2. If you invest 10 crores, it's same. 1 crore is same. 5 crore is same. So 1 crore is the ticket size. That is the SEBI ticket size.
Yeah. So Saurabh Benik is asking a question. Specifically, what are the parameters you see before investing in an MSME company? If you can summarize it.
Absolutely. In fact, we have a small methodology which we use because there's so many Excels we have. One Excel for financial model, another for industry, third for cash flow, and then we try and put it all together, make a few ratios. We get lost a lot of time. So we made a one summary which sort of captures 5 aspects. One, promoter. Second, industry. Industry may what's the time of the industry, how much of the industry can be captured by this company, what's the growth in the sector, do we have any regional modes or industry modes, does the promoter hold any PhD, or does he come from a family business where steel is in his blood for last 40 years and he knows everyone in the market. Those things help. Fourth is obviously the growth parameters of the company specific. Fifth would be the time horizon, what we're looking at. Will the idea mature in 4 years' time? Because the real kick will come in. So that's a parameter. And fifth is the volatility or the depth liquidity in the market. So if you're buying secondary, then we have to see, okay, what has been the liquidity in the market in past, because we don't want to enter into a liquid phase or we are not able to build enough position. I'm a 580 crore fund, including my undrawn capital. I don't want to invest 1 crores. I want to do at least 5 crores. So if I'm investing into something, do I see a possibility of making up to 5 crore of investment, which can then give me 10, 12 crores of exit? That is very important. So that aspect we've also put.
Got it, sir. So SJ is asking a question. Do you meet management of every investment you make? Do you do channel checks? Because recently Blue Smart promoters did a fraud and siphoned off money. So how do you screen for such promoters?
Oh, wonderful question. When this happened a month, in fact, 2 weeks before that, one of great, I should not name them, broker report came to me for Matrix, which is their gas company of the same promoter group. And they were asking for a 80 PE valuation on a 25, 24 number. And the business model was just trading gas in tanks. And I was like, trading company asking for 80p, there must be something I'm missing. Because they were selling a 4 year story where they would make this gas. And nobody has made gas, right? So, first is, incidentally, you should avoid the gas. No one has seen the future. God has not seen the future. You can only see up to 1.5 to 2 years. I, as a fund manager, don't have a 5 year vision or a sector vision. So you have to fairly see up to 1.5 to 3 years, protect your capital, and then look at vision beyond that. Yes, we do meet 80% promoters before investing. Many a times we buy on screen, build 2-3 crore book, which is 2% of the company, and then we meet the promoter. Because then the promoter is able to really respect your ideas. Promoter doesn't want a 2 or 3 lot investor to click in. And then we talk to promoter, we build more conviction, then we add on. If we don't, then we don't say goodbye. We say best of luck, sir, and we take our time to exit in 6 months. So yes, we do meet promoters, and about 20% of them where pre-IPOs we do. Almost every pre-IPO do. If we're doing it as a co-investment with other funds, we don't do factory visit, but we do factory visit. We check all the documents. We give it for legal due diligence, financial due diligence. We've gone to an extent of doing on the spot calls with the buyers and suppliers of the companies to figure out. In fact, we even do that after it's listed. So we do that, and especially for the companies who are in our top 40 holdings, because वहां पे हमें डर लगता रहता है.
So Sagar is asking a question: what is the typical average holding period for this fund for its investment in MSMEs, and how does it vary across different sectors?
We are sector agnostic, Sagar, complete sector agnostic. We are very specific on the scripts and the story of the script. Now, to understand every company is like a child. We have to see whether it's hit teenage. Teenage children are very aggressive. They make a lot of mistakes, and if they're lucky enough, they recover from it. Many companies are actually in the 30s, and 30s companies are typically companies who have been doing fairly well, growing at 12% speed, CAGR through their internal accruals, and now they're making an investment which is going to double down on efficiency. Or I know a company which was dealing in 4 plants, and all 4 plants were 30 kilometers away. So poor man had to manage. So he had to simply do one thing, which is raise money, get a huge parcel of land, consolidate everything, and that gave him 3 to 4% upside on his PAT. Because all his logistics and people and security, all the cost is gone. And he had to simply move his factory 4 hours away from where he was living. And I told him, you don't need to go to factory every day, you go every alternate day. So he spent about Monday, Friday for first 6 months there, stay back on the weekend, and now he goes every alternate day. He's put in a SAP ERP. He's put in cameras to monitor. So that aspect is built up. I hope I was able to answer Sagar's question.
Yes, yes. So Anand Sogani is asking a question: any plans to launch a PMS so that your strategy is accessible with a lower ticket size?
So the challenge with PMS is, in fact, many of the great fund managers are shutting PMS and going into AIF because as investors and as Indian investors, we are not uh, wired to share any sort of fees or subscription. In fact, OpenAI, we might be the best subscribers of OpenAI, but we might not be the best paymasters of OpenAI, right? Similarly, the same thing happened in PMS. So if I were a PMS and all my ideas were open to you, there are high chances you would invest into an idea which I might be exiting and you might be entering. So after 1 year, you would be in a situation कि यार ये क्या कर रहे हैं समझ ही नहीं आ रहा. So doesn't work. Secondly, if I am entering into an idea which I have not validated yet and I want to double down on it, 200 investors will buy it and will squeeze away the liquidity. So it sort of spoils the entire thesis of investment if your idea is publicly available because you don't know how someone takes it. It happens to us in anchor investments also. Our investors call us and say, "Sir, आपने वहाँ anchor लगाया था. I have taken this." I think every anchor I make doesn't mean that I will double down on it. I also wait for the next results or the projections to happen or talk to the promoter once again because once the IPO fades out in 6 months, promoter's tone is very different. Because promoter is trained to be a great sales marketing at IPO. After 6 months, he's got the money. He's struggling to get business. He might burn. He might say, "Okay, I'm very scared to burn money, so I will go slow, but I'll not go wrong." So you have to see the psyche of promoter to enter. So PMS will not work for us. A lot of PMSs are shutting down and opening the AIFs.
Understood, sir. I think we have come to the end of the session, sir. The remaining questions we will share it with you so that your team can answer and send it to the participants.
Surely.
Yes, sir. Yeah. With that, we formally conclude today's session. Thank you so much, Rishi sir, for sharing such deep insights and candid perspectives on navigating the dichotomies in MSME investing. Your presentation and perspectives have helped us understand not just the opportunities, but also the realities and challenges that come with this unique asset class. A big thank you to all our audience for your active participation and time. Your engagement alone makes these sessions truly meaningful. We hope you leave with fresh perspectives and actionable ideas to think about when it comes to MSME investing. Until next time, thank you and have a wonderful day ahead.
Thank you, everybody. Thank you, Arvind.
Thank you, sir.